Okay, this video is just going to be a quick example of how to use selling put options as a way to get a type of exposure to stocks while getting paid some premium income up front. Okay, and just some overall comments about options. I think one of the differentiators between beginner investor and kind of intermediate level investors, you're going to want to have some ability to use options as a tool to help improve your returns or help you earn some premium income. Basically, you're just going to want to be conversant in put options, call options, and the basic strategies. And I'll probably be doing a number of videos on both basic and more intermediate strategies with options. Okay, so this first one of selling put options is pretty much a basic one. And we'll talk about some of the risks, some of the pluses and minuses, and so on. All right, now we're going to just go to seekingalpha.com's website, and they have options printed here. You're going to see them with a delay. Obviously, any brokerage account that you use is also going to have its own menu, its own way of rendering option prices. So here with Seeking Alpha, we just go to, and I'm just going to use this company. I actually do own a little bit of this company, but this is by no means a recommendation to buy or sell it. Okay, we're just going to use it as an example. So you click on Financials. And then when the financials menu comes up, we're going to click on options. Okay. And so with options, basically we're going to have to choose a month and we're going to have to choose a strike price. And this video also assumes that you understand the basics of what a strike price is, what an expiry month is. This is sort of stuff that you're going to have to already know in order to follow along with this video. Okay. So if you look here, we've got calls up above. And we're going to have the put options are rendered down below here, okay? And we have different months that we can choose. And for St. Joe, we've got 4 different months. We've got July, August, September, and December. What I'm going to do is we're going to look at December 1st just to illustrate kind of one of the big differences in time value of options, okay? So remember, the stock's trading here at $43 a share. And we're going to look at an at the money or near the money strike. So let's look at the 42 strike. And so down here we're under the puts. And so you have the left column is strike price. And then this is the last trade. And then the number we're really interested in here is the bid. The bid is where you can sell the option, and the ask is if you wanted to buy a put option, this is what you would pay. Okay, but what we're going to be doing is selling a put option. And then we're just going to pick a strike price. And so you can see here, actually, there's a 40 strike, there's a 42 strike, and a 45 strike. There's actually no 43 strike. There's no at the money strike, but we just picked the closest one, 42. And you can see here it's bid at 360, and the ask is 390. So if you want to sell this option, you'll be getting $3.60 per contract representing 100 shares. So you would get $360 in upfront money by selling this option. And of course, it expires in December. So if in December, when the option expires, if it's trading below 42, you are on the hook to pay $42 a share for 100 shares of St. Joe, right? So really, your liability that you're agreeing to is basically, your max liability is $42 per share. Because in theory, the stock could go to zero, and you have to pay $42 for what later turned out to be a worthless asset, okay? And in return, you get paid $3.60 up front. So now, if you look at, this is the December month, okay? If we go out just to July, we look at the near month, so this is something, say, 3.5 weeks from now, and we look at the same strike price, the 42 strike, you can see that the bid, the price that we would get if we sold it, is 75 cents. So much, much lower proceeds. And that makes sense, right? This option is going to expire much sooner. And one of the major components of an option is the amount of time implicit or time existing between now and when the option expires. So the December option pays you significantly more, but in theory, you could do this July option, and then when it expires, if it expires, you can reload and do another one. And so this is sort of a matter of taste for a lot of people. Some people like to go short and do short-term options, and they can do more. They can reload periodically. I personally, and again, it's a matter of taste, I personally like to go out some number of months and just clip a higher premium. And but it's just a matter of taste, okay? So what we're going to do then is let's go back here and we can look at this 42 strike, $3.60 is your premium. Now, let's play out some scenarios. We talked before about how the stock could go to zero, right? But let's say the stock goes to 39. And of course, if it's at 39 in December when the option expires, it will actually get assigned to you at 42. And ironically, you'd be okay with this because you got paid $3.60 up front and you're purchasing the stock at 42 while it's at 39. So you're giving up $3 in terms of the difference between the future price, if it's at 39, and the strike price that you agreed to buy the stock at. And one other way to think about it is by getting a $3.60 premium up front at a 42 strike, you're actually synthesizing a stock price of $38.40, right? 42, the strike price, minus your premium is $38.40. So in a way, you're actually synthesizing a lower price. And this is one way to get exposure under certain circumstances, get exposure to a stock with also getting paid an upfront premium. Okay, now I want to make a few comments about put options because if you use these recklessly, they can literally put you in the ground. And so I don't like to use a lot of these. I recommend to people to do cash protected puts, to never use leverage with these, and also never use a lot of your cash, never sort of sign up or sign away a lot of your cash for this kind of trade. Because what happens is if there's ever a correction, you're going to have all your puts assigned to you and you're going to have no cash left to actually buy stocks at discounts, right? So it exposes you to a type of fragility if you do these to excess. So keep your put options selling to a minimum. I usually will do maybe 5 to 10% of my cash balance. Some people will do more. You have to sort of figure out what is your level of exposure, and trust me, it's going to be lower than you wish it were if we do have some kind of air pocket or some sort of major sell-off in the stock market. So don't do these to excess. The joke about put options is it's a lot like picking up nickels in front of a steamroller. And the steamroller, it rolls real slow. A lot of times you can pick up a lot of nickels and you can avoid the steamroller. But every once in a while, that steamroller rolls right over you and you get hammered. And so you just want to keep that metaphor, picking nickels up in front of a steamroller. This is basically what this is. But you can definitely pick up a lot of nickels, and if you play it on a level that's prudent, when the steamroller does roll over you, it's okay. You're only stuck with a couple hundred shares of some stock that maybe you wanted to buy anyway. Okay? So this is your basic put option, selling put option strategy. And as always, I thank you for watching, and I hope these videos help.